Good morning, everyone, and welcome to another installment of the Prosperity Through Multifamily Real Estate Investing Podcast. I am your host, Real Estate Cody. With me, as always, is the coffee connoisseur himself, Mr. Brian Alfaro. Good morning, buddy. How are you?
Cody, nice to see you. Always a pleasure to be here.
It always is a pleasure to be here. We're right back in the hot seat again with another great guest. Why don't you tell us who that is?
All right. Today, joining the show, we have Mr. Stefan Tsvetkov, who is the founder of Realty Quant, a company that brings data-driven and quantitative techniques to the real estate industry on a mission to add massive industry value through education, investment technology, and analytics. Stefan is a financial engineer turned multifamily investor, an analytics speaker, and a live webinar host. He holds a master's degree in financial engineering from Columbia University, and during his finance career managed about $90 billion derivative portfolio jointly with colleagues. He's been featured on multiple podcasts and webinar events, including Elevate, the Best Ever Real Estate Show, The Apartment Guys, and now the Prosperity Through Multifamily Real Estate Investing podcast. And he also hosts a Finance Meets Real Estate webinar series. Stefan, welcome to the show.
Thank you for having me.
It's a pleasure to have you here, Stefan. We're really looking forward to diving into our conversation today, especially talking about data-driven analytics, such a critical part of our business. But before we get into that, man, tell us a little bit more about your background.
Yeah, of course. So I'm Eastern European. I came to the States at 22 for my master's. I worked in the financial industry for about a decade. As like Brian mentioned, like managing like a large derivatives portfolio, kind of like on a trading desk with like several colleagues of mine. So that was my job for about 10 years. And in the recent couple of years, I've transitioned full-time to real estate. And I've been a multifamily, small multifamily investor in the New York City area. So doing like condominium conversions and like other projects in the New York City area with kind of discovered with data.
That's exciting, man. That's great. And being in New York, you just got to ask, how have you been weathering this pandemic and post-pandemic recovery over the past 24 months? I know New York has probably been an area that's been impacted probably the most as far as the real estate market goes. How are you guys doing to date?
Right. I mean, as far as the real estate market, definitely it's been I guess some strengthening of like older trends of domestic migration away from New York City, and as you guys know, to the Sun Belt and Western markets and so forth. So there were like during the pandemic, I had like a few friends kind of temporarily relocate to Miami or other places, but quite a few came back at this point. So I would say like the market as far as appreciation has been not so strong as obviously as in South and West, but it's been okay. So there hasn't been any, like any kind of negative impact, other than perhaps kind of having more moderate appreciation.
Yeah, it's interesting. I mean, obviously New York City is the biggest MSA in the country. I mean, probably the most populated by far. And it's hard to imagine that, it'll remain that way forever. I'd imagine the city's going to bounce back, and, it's just like any other city, right? There's always market ups and downs and such. So, but, it's interesting, always interesting to talk to our fellow colleagues that are in markets like yours and see what's going on there. But
if I may interject on that, I mean, there are scenarios, of course, like for some population outflow, and in the US, typically like a modest population outflow of like 5-10%. I mean, would be huge for something like New York City, but in other cities, typically does result in some of the tax base of the city essentially like being reduced, and can result in like some sort of deterioration and living conditions and so forth. So that has happened in the past in the Northeast. So it's not new. So I mean, it's not excluded for New York City for sure. And just hopefully it's not going to happen. Hopefully, or it could take quite a long time for that to happen, such as a scenario like New York City in the 70s or something like that.
Yeah, sure. Awesome, man. Well, Stefan, going back to your very decorated background in the finance world, like we mentioned at the beginning of the show, right? We're operating small businesses when we talk about commercial real estate, multifamily investing, and everything is derived off of revenue, income, expenses, net operating income, all the above, right? So it's very financially driven as far as making sound investment decisions. So talk to us a little bit more about how you found yourself coming from the financial background into actually the multifamily space, and how did you apply some of those skill sets that you picked up from your financial background to your business today?
Great question. Well, I first did kind of like house hacking. So I purchased a fourplex in New Jersey, like 25 minutes from Times Square. And so it was, so I lived in one unit. I was kind of living rent free. I thought that's pretty nice. It happened to be a fourplex where the unit was actually nice, and I was happy to live there. So I thought, okay, that looks like, and I had a little bit of a discount on the purchase. Like the seller was, was going through a divorce or so forth. So the price was relatively attractive, as much as it can be in markets like that. And so I thought, okay, you can get a discount, you can build a little bit of equity, and then like have all the cash for like principal component, etc. So I thought that's attractive. And I started looking into it a little more seriously. I started building up some of my scripts in like Python to just like Python, just your audience is like very rising in popularity programming language, also for like statistical analysis and things like that. And so I started kind of like writing scripts, and I started getting a little bit more professional. So, okay, I would pull, let's say about 6,000 small multifamilies, and some could be like, like a bit more units, but not so big as in the commercial, not like 100 units, more like up to like 15, 20 units and things like that in the New York City area. And I would kind of like have them all underwritten. And then I would start working on like more models, like writing my own like automated valuation model. And like an automated valuation model is kind of like Zillow's estimate, being able to price properties yourself. So I did that. And then I did like some condition scoring for textual description. So sort of like trying to achieve like true automated underwriting. So that was like the goal was, okay, let's try and look for like different inefficiencies and sort of to trade the real estate market the way you trade in finance. So that was the goal as much as possible. I mean, obviously it's illiquid, there are like challenges, etc. But on the other hand, those bring opportunity. So how to capture those? So how to like have like all the multifamilies in the area on market and some off market underwritten, and that. Then I started, since I've been transitioning into like commercial real estate more recently, and I bid on a property about like 50 units in Iowa and kind of trying to start in that space. So then I started like doing some off-market modeling for commercial multifamily, and I can talk to that. Like there's like some methods to do it a little bit at scale. It's a preliminary analysis that kind of goes beyond like the usual, where you're given an income expense sheet for a property and you review it, and it's like a single property that your acquisitions analyst reviews, but it's more like how do you scale this across like thousands and thousands of different properties in different markets, especially if you're relatively market agnostic. So these are like some like data-driven techniques. And then on the market side, at the beginning of COVID, I did some work on market valuations. So that was very interesting. So market valuation is sort of like your measure of, where the market is, like in terms of over, under, fairly valued, and what is your downside risk in the event of a market correction at the end of the market cycle. So I did like a study of that, like based on the global financial crisis declines that occurred in different states and counties. And I've been publishing this data at my company at realtyquant.com, and we have it for, I think, 2,700 US counties. So it's like pretty broad. It's pretty much everywhere. So that's been very useful, and I've been tracking, okay, how does it evolve? Like US real estate was like super fairly valued back then. And it, last year things started changing up a little bit with inflation and so forth. So those are like some examples of work on the property side and market side, but generally on the property side, it involves automated underwriting, automated valuation models, modeling for off-market inventory. It involves also scraping a lot of social media. For example, now I scrape like a lot of social media to seek for commercial multifamily deals. So that's kind of one approach. I'm sure perhaps other operators do as well. And yeah.
Brian, I'm interested to dive in this conversation for even further with Stefan here and kind of dissect a lot of these, data metrics that you're tracking. But,
Mhm.
Brian, I know you and I were both very, very data driven, right? And so, especially in today's time where there's so many different metrics that we're following, not just income, expenses, not just the financials that Stefan mentioned. What are your thoughts on what you're hearing so far, Brian?
This is very interesting. I think this is a way for operators to consider having a competitive advantage over some other operators that maybe aren't as data driven, correct? So, I'm looking at the Realty Quant website and one of your sample reports. Like he's got examples where they're doing real estate price momentum by county, for example. So you can start to look at an overall MSA and go, okay, which parts of these MSA really have momentum with rents, have momentum with price valuations and appreciation, and that can allow you to sort of nothing stays secret forever, but can allow you to maybe get a little bit of an early access in an area that isn't potentially overlooked by operators. So I think in today's competitive landscape where like I said, nothing's a secret, everybody's kind of flocking to the same markets, this allows you to take a little bit of a deeper approach and maybe look in some areas that maybe some other people aren't looking, and give you that sort of early access into markets that are on the up and up and will be competitive in the near future. So I like this.
Yeah, I agree. And Stefan, like I said, I want to dive into this further. First off, I kind of explain to us what this term data analytics means to you. And for the listeners who, I don't know, maybe just being newer to the space, or even our passive investors who are wondering, hey, how do I really evaluate an opportunity? How do I really make sure that, what the information that's given to me is really accurate or tangible? Talk to us a little bit more about that definition of data-driven analytics.
Yeah, that's a great question. And well, I did a presentation where I was like sharing sort of what to me is data-driven investing and what's not. And so you can say like, I can speak to also what I think is not exactly data-driven. So we have, for example, well, obviously manually underwriting deals, even though it's a necessity, you need the human factor and so forth. And I've been actually working on hiring an acquisitions analyst myself at the current time for the same reason that automation alone is not sufficient. But that said, manually underwriting deals is not data driven and kind of not performing. I would say when you have off-market inventories like it is in the commercial space, but not performing kind of modeling or some kind of analytics on them, even in a preliminary sense, even though they're off-market and you know so little about them, but you can still get some insights. So that I would say is not data-driven. And then another thing is on the market side. Well, if you pick a market and you say, okay, it has, let's say you pick Atlanta, Georgia, and it has like X population growth, job growth, etc., like all those metrics. Does it mean, like that they're predictive of appreciation necessarily? Generally, yes. But I did a study where the best way to predict appreciation is to take the price time series themselves. And now there are like all kinds of considerations for that. You need to like difference the time series, so on and so forth. And that's just methodologies that you can have, like perhaps an analyst of yours do that and so forth. But that said, when I went the route of predicting population, predicting income, predicting housing supply, then the prices of that, I got a like 5 times bigger error in my price forecasting. And that's not so, and that is at a time such as 2018, 2019, I was doing the prediction for, there was like a very easy trend in the market, kind of easy to predict. And in fact, predicting the prices themselves had only a like 1.4% error. It was very close, the forecast, to the true prices at the state level, and then like bigger error at like county and so forth. It's naturally harder to predict smaller geographies. But that said, predicting the prices themselves. And so like kind of like looking at all those metrics, but not like putting them in an actual regression and like having like an end-to-end specific forecast for next year is in itself not exactly data driven. And then also another thing is not having downside risk, not having risk management. So downside risk is to me like one of the big things, because Brian mentioned like he looked up like some of our sample reports, and yeah, we do have like the price momentum, so sort of this kind of appreciation indicators. But the bigger thing for me is really measuring downside risk or like market valuations, because that's something that I feel like so many people lost their entire net worth post the global financial crisis, who are very successful operators at the time. And, and obviously it's not like to kind of scare people off, since US real estate has been extremely fairly valued, at least through the first quarter of 2021. And it sort of started changing after that, and I can speak to that. But kind of not having downside risk predictors is another like aspect of, sort of not true data-driven investing. So manually gauging property values instead of with a rigorous model, automated or like actual or be it real appraisals and so forth as well, not technically data-driven. And another thing is if you pull like reports that are in themselves data-driven, like Marcus and Millichap reports and so forth, and they can be amazing, but are you really building intuition yourself? Are you trusting those reports enough? And this is where a lot of the advantage comes from in data-driven investing, that you're going to actually trust those numbers. Like I use in my own investing, like downside risk, like market valuations, I use them as almost hard data because I've seen their correlations. I know they've predicted at the state level, like post-global financial crisis declines in their magnitude, not timing, to an 85% correlation. And they've predicted county level, like for close to 3,000 counties, right? To a 75% lower correlation. So I have like a comfort with that because I've kind of interacted with the data, and that allows me to be also more productive in the very usage of the same data. So that is like some of it, at least for myself. If I pick a report and just read a report, it's usually not enough. It takes a little bit more digging into. And so those are like just kind of like a summary of kind of the mindset or perspective. But generally on the property side, it involves a lot of automated underwriting. So pooling deals and underwriting in an automated manner. And it's a great question, like for investors who are mostly concerned with off-market deals. How do you do it off-market, right? It's like, how can you underwrite something where you almost don't know anything about the property? And so one approach to that in the commercial space that they put together and been working actually on releasing a product on it is commercial multifamily off-market modeling for kind of lead generation purposes. And the way to do that, if you have quality rental listings data, the other rental listings data could come from places like apartments.com, apartment finder, and so on and so forth, like the various listings for some of the bigger apartment buildings. And you can model this data to whether rents are below market relative to the immediate neighborhoods, but you can also model some of the other revenue and expense components, because some of those listings they would say, okay, what pet fees, administrative fees, and so forth are being charged by the respective building or operator, and would also give a mention of what utilities are being billed to the tenants or not. And so based on this information, and you could also have like some sort of sense of vacancy based on like how many listings are coming out. So between those components, like rents relative to immediate neighborhood, other income components relative to immediate neighborhood, utilities billed or not relative to immediate neighborhood, and the occupancy, you can get some sort of very preliminary modeling for the NOI improvement percentage, or how much value add you can get on a given building. And one can say that's like super preliminary. Yes, it's not the true expense sheet of property that you would get from an agent. But if you think about it, this is really like a preliminary income expense analysis that you can do across thousands and thousands of commercial properties in many markets. And so that kind of becomes data driven. So let's say myself, I would run a system like that. I would look for only commercial multifamilies that seem to show value add potential, and kind of focus my direct marketing campaigns to those. And naturally, now then one can argue, okay, direct marketing is perhaps just 10% of the whole story in commercial. It's like 90% agent relationships. But even then, even being focused in a single market, it's good to know what are those prized assets, if you will, that have the biggest potential. And then you can, be it like take the owner to dinner or whichever approach, or just like have, keep following them over the next 5 years or something like that. But again, like having this kind of insight and intelligence is useful. And so kind of really having a sense of where, what the value add properties are at scale, really almost nationwide, if you will, and having a sense of where markets are, one, in their strength, in their appreciation, which, okay, that's like publicly available data, easy to see, but also where market valuations, like is Florida 10% overvalued? Is it 20% overvalued? Is it fairly valued? Like, where exactly does it stand on a metric that's relatively statistically predictive? And that has worked to predict, at least we have an event that's like kind of, okay, we don't know if it's going to repeat itself naturally, and hopefully not, but kind of we have a worst case full price correction scenario event, which was, the post 2007, 2008 decline. So we can kind of calibrate a model relative to that, okay, hopefully things work out better, but it's sort of a worst case scenario model. It's definitely the worst decline in US recorded price history. So these are like some approaches. And I can speak to actually like some of the markets and like how I see them at the moment in terms of valuations, where they were. And you can compare to some studies, like there's studies done by Bloomberg Economics and other. There is one at Florida Atlantic University. There's one by Local Market Monitor, which is a vendor that Neubauer uses, as far as I know, for some of the market statistics. And so that's actually that's another question if we have time.
Yeah, we could definitely go down there in a little bit. But Brian, I want to highlight here, Stefan, I love how granular you're getting in the data here, because and we're getting very technical, but I think there's a reason why information is key, right? And Brian, you alluded to this earlier, where the more data that we have at our disposal, the better investment decisions we can make, the better sound fundamental decisions we can make. But I really want to go back to your point about the mindset you mentioned earlier about protecting it against the downside. And ultimately, that is our number one objective as investors, right? I mean, listen, we can buy properties at whatever valuation, we can project whatever assumptions, but ultimately our number one responsibility is hedging against our downside risk. And, having data like this is critical to being able to put yourself in a position to hedge against that risk. Brian, any thoughts there?
Absolutely. You got to use the data to your advantage. Now, it's not going to be a crystal ball, like you said, and tell 100% of what's going on, but it can at least help you make more sound, educated decisions. So using data to your advantage in commercial real estate is super important. You can't always just go by your gut feeling.
Right. Yeah, 100% agree. Now, Stefan, in talking about this, I mean, you listed many, many different metrics here that you're pulling together, which again is very impressive. But it's a ton of data. Where are you pulling the information for these metrics? What resources are you using? Who on your team is helping you with that? Because it seems like that's a lot of work.
Yeah. Well, in my team, so I have an online marketing person, and I've been working on hiring an acquisitions person, but the data, kind of call it data science or data analytics part, I do myself. I was considering hiring a data scientist, but then I realized I actually do worse at the other tasks. I don't do so well with, I'm good at underwriting, but I get bored with it. I kind of don't like doing it all the time. So I felt like, okay, let's focus on it and get help with some of the other components. So really doing it myself. As far as the sources, so on the market side, it's publicly available governmental data. It's Federal Housing Finance Agency for prices. Obviously one can use those places like Zillow and so forth, but really governmental agencies, U.S. Census Bureau, Bureau of Economic Analysis for incomes. U.S. Census Bureau is for housing supply and population, obviously. So that's where. So it's pretty, boring kind of sources, that are easy that anyone can access on the market side. But we're very fortunate, I think, in the U.S. for having that data quite well available, at least at the county level. And even some zip code or kind of ZCTA is available as well if one wants to get more granular and do more work and kind of do a deeper dive of that. And on the property side, it's trickier. There are a few vendors who offer different components. Be it I use different APIs for all the owner information and so forth. And then I use there's a vendor for rental listings data called Datafinity, but they really web scrape the data, and I web scrape some data myself, or web scrape Google and places like that. So this is always scraping is extremely common over the internet, and basically everybody does it, but it's always one of those things that you should consult with your internet attorney for how to best do it. But there are multiple vendors again that provide some of the property site data, and some of them are not terribly expensive, and some are. So.
Got it. Got it. I want to go back, Stefan. So you mentioned, in the different various reporting that you're doing or metrics that you're pulling, you're looking at appreciation forecasts, price index forecasts, things like that. What are you seeing as far as deltas in your metrics that you're compiling versus where market rate values are for certain, apartment buildings, for example? Right now you're seeing a very aggressive cycle. Asset valuations are steadily moving and increasing, seems like week over week. What are you seeing in your data versus what market rates are going for right now?
Yeah, that's a great question. Well, I think some of the concern that people now have is, okay, the spread of cap rates to interest rates, right? With interest rates rising and then cap rates continuing to compress. And then I saw somebody I know, I saw a post on LinkedIn on actually, that you thought was a good point. Cap rates are in their nature are a little bit like a real interest rate for, especially in the commercial space, for the value of the property. And so one can kind of a little bit philosophical, but kind of think of they correlate with real interest rates better. And that has been kind of the historical case. So nominal interest rates rising, but with the super high inflation that is, the real interest rate is super low and negative. And so it's very interesting to see where the spread is going to be, or if there's going to be too much spread at all as far as cap rates to interest rates to nominal interest rates goes. And so that's some of the concerns there. But one of the things I wanted to mention as far as that I observed in this cycle, we also the very high asset inflation that happened in 2021, places like Phoenix, with the enormous rent growth and so forth. Now, most of the narratives I see on that side is, inflation is good for hard assets. That's correct. If you're running then your appreciation forecasts under this environment, you're going to see super high appreciation predicted in Phoenix, super high appreciation predicted in Boise, Idaho, Salt Lake City, places like that. But that said, the one thing that I see that I think has been, perhaps missed by some of the other analysts, or at least I haven't seen, is the downside risk that it brings. So what happened in Arizona is prices increased by about 17% at the state level in the first half of 2021. It's an example, but incomes increased only 1%. And so that brought some of the fundamentals based metrics that, for example, we issue at Realty Quant as, led them to reach a more overvalued level. So the state of Arizona was historically, for about 4 years back, was in the around 15-16% market valuation, kind of overvalued. Very strong market, but overvalued, but pretty mild and kind of staying the same. So quarter after quarter now around 15-16%. And so that actually increased to what is the second most overvalued state at about 31%. So basically it started bringing a little bit of a bubble in some of those markets. And that's easy to see in that data. And to clarify, those are metrics that in post-global financial crisis, they correlated extremely high to the actual declines. So post-global financial crisis, places excuse me, California, Nevada, Arizona, and Florida at the time, which were 40 to 60% overvalued on call it affordability deviation versus historical levels. And I can speak there several methodologies to how to gauge if a market is overvalued. But in this kind of simple measure, kind of price income ratios, deviation versus historical level, those states and specific markets in them were even differently, obviously, but 40 to 60% overvalued. And that was roughly the decline that happened there. It was 40 to 56% in Nevada and so forth. And there were other states at the time, about 10 states that were actually undervalued. Even Texas was there at the time. So Texas was 5% undervalued and it experienced only a 4% drop in prices. And that's the global financial crisis. Texas prices just barely drop. If you have people who've been around at that time. So for example, I had Vinny Chopra at my webinar, and he did his first multifamily syndication in 2008. And he had a very high return in that project, and it was a good project. But one of the reasons why he didn't have any impact at all as far as the market prices is, he was in an undervalued county in an undervalued state. And so what happened then is that undervalued counties in undervalued states, they barely dropped in prices. And so like I said, so the average drop for those states was like 4% only. And 4% was really the median income drop in the US at the time. So let's say if you look at in prices normalized by personal income in a given area, market valuations essentially didn't drop. So it's kind of stayed the same, like in price to income terms staying the same. So it's very, very interesting. So we have like the big global financial crisis, but if you're in an undervalued place, you're actually kind of protected. So that's very interesting as far as downside risk. And yeah, so in 2021, with asset inflation spiking, but some of the fundamentals not moving accordingly, like income, population, and housing supply, their combined effect, call it, at least our metric at Realty Quants kind of doubled in Western, I would say the 5 Western states of Idaho, Arizona, Utah, Colorado, and Nevada. Idaho, Arizona, Utah, Colorado. Yeah, those are 5. Colorado and Nevada, and then also they doubled in two lower levels, but they doubled also in Florida and Texas. And it's not a I wouldn't say it's a bubble there yet, but kind of like became a little bit more, where Florida and Texas were in the 8 to 10% valuation range, positive 8 to 10% for about 4 years. So 4 years, they're always 8 to 10%. You know, these things were kind of pretty consistent. And suddenly in the second and third quarter of 2021, okay, now it's 17, 18%. So this is like some of the effect of when you say, okay, inflation is good for hard assets. Yes, sure it is, because you make a ton of money from that and all the cap rate compression that happens in rent growth and so forth. But simultaneously, it's good to be aware of your downside risk towards the end of the cycle. And that could be, so basically that's second and third quarter of last year is what I see as the first indications of entering at all an overvalued place, the state at all, because it actually was fairly valued before. And I was going to events and I was saying, oh, it's fairly valued, US real estate is fairly valued. And Bloomberg Economics, they publish a report for different countries, and they were showing US real estate is fairly valued as well. And then other countries like Canada, New Zealand, Australia, like places in Scandinavia, like Sweden, and to some extent the United Kingdom, were actually very overvalued. So Canada is kind of a bubble. It's quite interesting, but US was not. And that was kind of also what was aligning with investor intuition. We didn't feel like things are that crazy. You know, people would always talk, oh, is the market too hot? You know, it's too hard to find deals, etc. And they do that since 2015, 2016. But really the market truly was not overvalued until the first quarter of 2021. And it started getting there in Western states and some Southern states, but predominantly the 5 smaller Western states that I mentioned towards the middle of last year. And so that's kind of what I see. But if we look at like before the global financial crisis, so US real estate was super fair valued in 2002. And then by 2005 was like a crazy bubble, and then kind of burst in like 2007 only. So that is like quite interesting. It can take a long time, and that's why like the timing up to that, there's like really no prediction. But it's good to know why it is so, why this is a measure of downside risk, and the reasons are U.S. real estate is fundamental. It's a fundamental asset. It's driven by population. It's driven by income. It's driven by housing supply, and so deviations from that are predictive of downturns. So that's kind of when I did that study for the global financial crisis, I tested all kinds of variables. I was looking at foreclosure rates. I was looking at price volatility in different markets. I was looking at like risk-adjusted returns. Those things were not predictive of the downturns. So like people would say like a state like New Jersey has like very high foreclosure rates. Perhaps it's exposed to more downside risk. That I was seeing reports when COVID started. It's actually not true, because yeah, they have the highest foreclosure rates at the relatively low foreclosure levels that we have at the peak of the market when things are very nice and so forth. But that said, they are undervalued. You know, the Northeast is undesired, and that's kind of like some of the dynamic there. And then in the beginning of COVID, I can give a kind of a positive example of market that was fairly valued, that had experienced huge appreciation, was Denver, Colorado. So Denver was like top 5 city in the country, and nevertheless at the beginning of COVID it was exactly at 0%. So that's kind of like to give a perspective. It doesn't have to be like a really well-performing, it doesn't have to be overvalued, but it just sometimes happens to be the case. And if some of your audience listened to also, I mentioned a bit earlier, Neil Bawa. So he speaks of like what was the best performing city this market cycle, and that was Boise, Idaho. And that's easy to see, just price histories. And if you look at, I think if you expand as far as to 800 cities, it's still Boise, Idaho, at the top of appreciation. It's quite interesting. But then Boise, Idaho is also very overvalued. And it's been like that since the beginning of COVID as well. And I spoke on it back then. And it is the best performing city. It's also the most overvalued one. And then there's some mid-range, varying by market, but let's say states like Indiana, Kentucky, for example, where some multifamily investors want to go, but they're still fairly valued, and they have had like solid appreciation. So it's not like the Northeast, let's say, as an example, or other Midwest as an example of more depressed markets that they just underperform, and that's why they're kind of a bit negative in their valuation, because they just even are performing quite poorly, even compared to their fundamentals. But then, it's not like there, but okay, well-performing, place like Indiana generally has like healthy price performance, not as strong as the West, obviously, and not as strong as the South, but healthy price performance and still fairly valued. So it just becomes a question of, I don't discourage people from investing even in Idaho, where, kind of Idaho, I would say the most overvalued state. I don't discourage even investing in Idaho because I run for appreciation forecasts, like I mentioned, and the highest appreciation forecast that I have for next year, assuming we stay under the same market cycle, it's in Idaho. It's actually in Boise. So when people say, okay, like if I say, let's say Boise is overvalued, it doesn't mean I'm negative on Boise. It's both things are true. It has the highest appreciation forecast, and it's also simultaneously carrying the biggest downside risk at the future uncertain time point, several years from now or wherever it happens. And that just kind of then becomes this risk reward analysis of what risk tolerance one has. So let's say, for example, let's say I've been switching to the commercial space, as I mentioned, and maybe it's more risk averse. I look more towards places like mentioned, Indiana and Kentucky are some of my top states and specific markets there. But then I also work towards Florida, and I have considerations about Florida because, okay, it's not that overvalued after all, and things are, just starting, can last for 4 years and so forth. And that's the place where it has like some of the highest momentum, some of the highest autocorrelation. So last year price growth correlates very high with this year price growth. So it's quite interesting. So real estate in some states is very momentum driven. Like an exception of that is Alaska actually was the only state that had negative autocorrelation. So there's no trend there. So it's kind of even negative. Even if last year prices did well, this year to do not well, it's kind of doesn't make sense. It's strange. But the general case is like Florida, 77% autocorrelation. So it's actually, you don't even need to be like a fortune teller or something. You just invest there. If it's doing well, it's probably going to continue doing well until the market cycle ends at some point, and that's where like the downside risk part comes into play. But again, I consider, let's say, like Florida is, I think their valuation I see as of latest government data around 17-18%. It's not a bubble. It's kind of, it's a very strong market as well, but it's not at least over 20. So one can invest there, and you carry some downside risk, but maybe if you invest for like 2-3 years, kind of manage your time horizons, it's also a consideration. So it just becomes a question of, again, risk tolerance, because again, to repeat, these same more popular, trendy, places, they're going to also perform really well now. So it's just a matter of risk reward. If one wants to hit on the trendiest markets, but if it turns out to be towards the end of the cycle, then carry some downside risk, or maybe the cycle continues for 10 years forward or 5 years forward or so forth. We never know. But this is the measure of magnitude for the downturn whenever the cycle ends, assuming we experience a sharp price correction scenario like global financial crisis. And there are other scenarios, by the way. Like if a market is, let's say, overvalued, it doesn't need to, and we probably are running out of time, but it doesn't need to like correct. It can resolve by, let's say, income super growth. So that's actually some of my hope for the current time, because I was seeing, okay, in 2021 valuations kind of broke, and they were really nice before and kind of now went a bit high. And I'm not so happy about that, since it kind of limits me in some of my selection. I want to go in the trendier markets myself too. But then okay, so, but then I was hoping maybe incomes will catch up, with inflation. So that's kind of the whole consideration with inflation. If income and other fundamentals grow accordingly, then it's all super nice. It just doesn't always happen like that. And so I was hoping maybe some of the overvaluation will resolve. So I'm still waiting for like the future quarters data, to be released by governmental agencies to see actually maybe it's going to kind of slow down a little bit and be, come down a little with income growing. So that's like once in our income super growth. So let's say prices grow very moderately, but if income like super grows and kind of catches up, then it could resolve the overvaluation. There's no correction at all ever. And then it could also be that prices continue, that let's say prices become stagnant is another, just like prices become stagnant, grow less in the future. So there's no correction, but they're just stagnant over the long run and income catches up very slowly, gradually. But yeah, those are kind of the three: price correction, income super growth, or like more stagnant prices, kind of generally three scenarios to resolve. So that's on the market side. That's what I use myself as an investor. So I look at downside risk. And like I said, on the appreciation side, I look at not so much the fundamentals there, since I reason like fundamentals are already reflected in my downside predictor. For appreciation, I want to actually capture the noise. I'm actually more interested in that. I want to capture even like the hype, if you will. So that's like, because it's like a 1 year ahead appreciation. So if there is like things like even irrational upside, that's fine. I want to capture like all the pricing, all the components of pricing, whichever they might be. And so then the forecast is just purely based on the price time series, like I mentioned, because that gives a 5 times smaller error than going the fundamentals route, which is kind of the standard investment manager route, I would say, when you pick like all your components, job growth, population growth, so on and so forth. But how are they actually predicting the prices? Then you need to do that. And so if you actually do it holistically, this kind of study, and you do it as a numerical kind of thing, as a regression, then you find, you commit a bigger error inherently by this approach. And so I've been kind of urging like some investors and operators to, just take even an easier approach. Just look at price history. And it sounds kind of silly because price histories are, as if like historical performance is not a predictor of future performance, but actually in real estate, to an extent, it has been, at least based on autocorrelation. And so that's something that, like I said, autocorrelation for it was about 77% in like Federal Reserve data, 79 in Massachusetts, and perhaps around 65 in Texas and so forth. But generally, it's a positive, positive trend for if a market is doing well, to continue doing well.
So Stefan, you covered a ton of ground here over the last several minutes, and really, really appreciate that deep insight into, some of the trends and data that you're seeing across all of the U.S. territories. I think that's a phenomenal information. It sounds rudimentary here, Brian. We've been talking about this a lot lately, right? But really diving in and understanding market dynamics is crucial right now, and looking at this data and interpreting it, because I think a lot of investors right now are resting their laurels on the fact that we are in an inflationary environment. Historically, hard assets do perform well in inflationary environments, but that's not enough to carry you through a life cycle of a deal, right? You can't just rely on the fact that, okay, yeah, CPI 7.9 and inflation's great, and my rents are 15, 20% on lease trade outs. That's all great, but that's not sustainable. And so you really have to understand, what are the underlying drivers in your markets, your micro markets, that are going to impact your overall business plan and operations. And so, having a platform like yours, Stefan, is, I think, crucial. I mean, like I said, you just gave us a ton of nuggets across multiple different markets that I think people are really going to be able to digest and benefit from. So really appreciate that insight. I wish we had more time to kind of dive into some of that further. And I definitely can see your passion for this data. So that's awesome. But, we're wrapping up here. We're kind of running out of time. But I want to kind of ask one last question before we get into our final 4 questions for you. And your platform, your data-driven platform that you're using, is this something that you're keeping internal just to you and your team, or is this something that you're offering as a service to other investors as a third-party service?
Mm-hmm. Yeah, great question. So most of the models, I would say, are in-house, but the market data side, market evaluations is available at realtyquant.com. And I've been working perhaps in the next couple of weeks for releasing a off-market commercial multifamily kind of analytics that I shared as far as like finding like value add properties in different markets that are still off market, but sort of like modeled at scale. So I've been working on releasing that. But yeah, most of it is in-house. Market data is already there, so people can see if they can reach to me as well if they want to know like if their market is overvalued and so forth. I know like some people worry about that, and it's pretty nice and favorable in so many parts of the US as far as that goes. So and it's not it's kind of quite calming, I think, for some investors. At least it was for me when I did that study back at the beginning of COVID. So.
Awesome. Well, we'll definitely make sure to reference your platform in our show notes. We'll make sure that's available to the audience. But Brian, before we get to our final four here, any questions for Stefan or anything that we didn't cover?
No, I think we did a good job highlighting everything that's important for our both active and passive investors to consider. It's just really the fundamental message is understand your market before you make an investment decision. Look at the data, look at what the data is telling you, read between the lines, and make sure you do your thorough analysis. And I think it was great points.
Yeah, well said, buddy. Well said. All right, Stefan. Well, getting into the final four here, man. We like to spend a few minutes kind of diving into you a little bit more on you, a little bit more about you on the personal side. Excuse me. So one thing that we love to ask all of our guests is, what do you like to do for your continued education to further your investing?
Great question. Well, myself, kind of by the mindset that I shared here, it ends up, I don't read so many books. It's a bit of a weakness. I try to get like new skills. So I want to be better at like things like machine learning. I feel like I feel like everybody should be able to do it in the future, and kind of know like AI and stuff like that. It becomes a bit of a crucial skill, or at least have people on his team who are able to do it. So I've been trying to dig more into that, and like things like natural language processing, computer vision. And so I don't know, for me, it's strengthening technical skills. I do try to get a little bit of knowledge from like business books and things like that, more on the mindset side, but I've more focus on hard skills and knowledge.
Love it, man. Love it. Looking back at your trajectory, what was that one moment of time or one event that kind of changed the course of your business?
Yeah. Well, just discovering like switching from finance to real estate has been one. I would say for some of the discussion we had today, finding out market valuations was a bit of an aha moment for me, because I always thought it's very hard to predict things, and like things are always so random and it's stochastic and so forth, like they're in the stock market. And then for me, it was a bit of an aha moment to discover that one can actually have fairly good metrics to manage his business, where one can have business continuity and not worry should I sell my assets and so forth, what if the market is overheated and things like that. That was for me an aha moment back then, like seeing all those high correlations in the 70s and 80s% for global financial crisis downside.
Awesome. What advice would you give to the listeners to help them grow their businesses?
Yeah, I think to hire people a bit early on, unless they're like really efficient themselves. Hire people, even if it's like virtual assistants abroad, as long as they have a good approach to doing it. But even I would say hire abroad and early on, and build systems that interact, that work together with those people, even on the marketing side or the investment side, that work together with that team that you're building, and that are like technical systems that help you, discover deals, market your, events, and so on and so forth, that kind of automate and make your life easier. But don't only build systems, but also hire people early on, because otherwise, you don't scale very fast. So.
I think that's great advice, Stefan. I think that's something that Brian and I both would 100% agree with you there for sure. So, all right, Stefan, tell the audience how they can learn more about you and your platform and get connected with you.
Yeah, the best way to reach me is my website, realtyquant.com. they can also reach me on LinkedIn.
Excellent. Well, Stefan, want to thank you so much for tuning in with us today. Great information. We definitely look forward to staying connected and learning more about your data-driven analytics platform.
Stefan.